Hey everyone, this is Matt with the Fundamental Investing Institute. Today's concept brief, we're going to talk about the accounting journal and the rules of debits and credits. So in the last concept brief, we introduced double entry bookkeeping and talked a little bit about how that was brought into the West, and of course it's still in use today. Today I want to talk about the accounting journal. So I brought with me today something that you can buy at an office supply store. So when we teach accounting, we always use a paper system to start out with, at least for just a handful of transactions. And we use these columnar pads that you can buy, and you can create an accounting journal out of it. So with the accounting journal, we actually record a few different things. We record the accounts affected, the debits and the credit entries, and those are the numerical values that are associated with the transaction. We have the date of the transaction, and then we have a reference number for the transaction. So, and the journal is going to record all of these chronologically. So we're just going to record transaction after transaction as they occur. The columns in which we record the transactions, these are known as the debit column and the credit column. And this just means left and right respectively. So on the left is the debit column, on the right is the credit column. So we have some rules that we use. Now there are 5 kinds of accounting, there are 5 kinds of accounts that we use in accounting, 5 basic types. And those are, we have asset accounts, liability accounts, equity accounts, we have income or revenue, and then we have expenses. And those are the 5 basic types of accounts. And the rules of debits and credits are as follows. So debits will increase an asset and an expense account. They will decrease liabilities, equity, and income accounts. Likewise, credits increase liability, equity, and income accounts, and they decrease asset and expense accounts. So just one simple transaction, for example, would be if you bought office supplies, let's say, and you used a credit card. That office supplies would be an expense. So you would debit that account, and then the credit card, the offsetting liability, which is the way that you pay for it, that credit card is a liability. So let's say it's an American Express card, you would credit that. So you'd have your debit, which is the expense, you'd have the credit, which is the offsetting increase in that credit card account balance, and then that keeps your balance in total. And then as we go through more concept briefs, we'll talk more about this process in which we use these transactions and then eventually bring them to the financial statements. So thank you for tuning in today, and we look forward to seeing you again.